Should you let artificial intelligence pick your stocks? In 2026, that question no longer sounds futuristic. AI can scan earnings calls, compare valuation ratios, summarize filings, and produce a confident answer before you finish your coffee. But speed is not the same as judgment, and confidence is not the same as truth. A recent survey of 1,000 affluent American investors found a fascinating contradiction. 61% expected AI to have a positive long-term effect on markets. Yet 67% were worried about an AI bubble or an AI-driven market correction in the near term. That tension is the real story. Investors believe AI will matter. They are far less certain that today's prices, predictions, and promises make sense. So the useful question is not, can AI analyze stocks? It clearly can. The better question is, which parts of investing should AI handle and which decisions must remain human? Let us begin with what AI does well. Imagine that you want to research a company. Traditionally, you might open an annual report, read an earnings transcript, compare competitors, examine margins, and search for risks. That can take hours. AI can compress the first pass into minutes. It can organize information, explain unfamiliar terms, and point you toward questions you did not know to ask. Used this way, AI is not an oracle, it is a research assistant. That distinction matters because AI systems do not understand a business in the way an owner does. They generate answers from data and patterns. If the source material is incomplete, outdated, biased, or simply wrong, the output can still sound polished. The United States Securities and Exchange Commission has warned investors not to rely solely on AI-generated information when making investment decisions. AI can use inaccurate or outdated data. It can also produce information that is completely made up. This is where many investors make their first mistake. They ask AI for a conclusion instead of asking it to improve their process. Tell me the next stock that will double is a bad question. It invites false precision. Summarize the last 4 earnings calls, identify changes in management language, and link every claim to its original source is a much better question. It creates work you can verify. The difference is simple. One question asks AI to gamble for you. The other asks AI to help you investigate. Before trusting any AI-assisted investment idea, use the S.T.I.P test: source, time, incentive, and portfolio. First, source. Where did the claim come from? A company filing, an audited report, a regulator, or a social media post repeating another social media post? If the tool cannot show you the underlying source, treat the answer as a lead, not evidence. Open the original document. Check whether the number actually appears there. Read the lines around it. Context can completely change the meaning. Second, time. Markets move, companies update guidance, and economic data gets revised. An answer can be accurate and still be useless because it is old. Always ask, what is the date of this information? What happened after that date? Has the company issued new guidance, raised capital, changed management, or reported a new risk? An intelligent answer built on stale data is still a stale answer. Third, incentive. Who benefits if you believe this story? AI-related language can make an ordinary product sound revolutionary. Regulators have warned that scammers and promoters use artificial intelligence buzzwords, guaranteed return claims, and fabricated platforms to attract investors. Ask whether the company is creating measurable value or merely borrowing the vocabulary of the moment. Look for revenue, customers, margins, cash flow, and credible disclosures. A powerful narrative cannot replace a functioning business. Fourth, portfolio. Even a strong company can be a bad decision if it makes your portfolio dangerously concentrated. An AI tool may evaluate a stock in isolation. Your financial life does not exist in isolation. You may already own the same companies through an index fund, a retirement account, or an employer stock plan. Adding another position can quietly turn enthusiasm into concentration risk. Before buying, ask 3 questions. How much of my portfolio is already exposed to this theme? What happens if the price falls by 50%? And would that loss change my real life plans? If the answer to the third question is yes, the position may be too large, no matter how exciting the forecast appears. Now consider the most important human advantage, the ability to define the goal. AI can optimize for the instruction you give it, but it cannot decide what a good life means to you. Are you investing for a home in 5 years, financial independence in 20 years, or retirement income in 40 years? Those goals require different levels of risk, liquidity, and patience. A stock ranking is not a financial plan. This is why the best use of AI may be less glamorous than people expect. Use it to translate complex filings into plain language. Use it to create a checklist. Use it to compare a company's claims across several years. Use it to challenge your favorite idea by building the strongest argument against it. Use it to identify what you still do not know. But keep 3 decisions human. First, the decision to verify. Never outsource the responsibility to check important facts. Second, the decision to size risk. No model knows how a loss would affect your sleep, family, career, or future choices. Third, the decision to wait. AI produces instant answers. Good investing often rewards the opposite behavior: patience, restraint, and the willingness to do nothing. Here is a practical workflow you can use today. Start with a diversified plan that does not depend on predicting one winner. When a company interests you, ask AI to build a research map, not a buy signal. Require links to primary sources. Verify the most important numbers yourself. Compare the opportunity with simple alternative such as remaining diversified. Decide the maximum loss you can tolerate before you place any order. Then wait 24 hours. That final pause protects you from the emotional momentum created by a persuasive answer. Artificial intelligence will almost certainly change investment research. It may make high quality information easier to access and difficult documents easier to understand. That is valuable. But a faster tool does not remove uncertainty. It can make uncertainty look more convincing. So, should you let AI pick your stocks? No. Let AI expand your research, pressure test your assumptions, and expose gaps in your thinking, but keep control of the decision, the risk, and the consequences. The investor of the future will not be the person who blindly trusts AI. It will be the person who knows exactly when not to. If you want to build wealth without losing your judgment, subscribe to Capital and Character. Build wealth, build yourself.